Today we start the second quarter of this Accounting 1 course, topic number 5. As you see on your course page, there are actually 3 videos today. The first one I'll come back to in a few moments and explain, and the second 2 are the assignment for today. I will ask you to watch these 2 videos, and there are a couple questions after each one. So let's go back and review just a moment. Topic 5 will be the next step in our accounting cycle. We looked at journalizing in topic 4, and now we're taking that information and going from the journal to the ledger, and that process is called posting. That's what topic 5 is about. As I said earlier, the 2 books of the business that we'll be using are the 2 basic ones that businesses will be using. There are others, but we'll be concentrating on these 2. And of the 2, the ledger is more important. As I mentioned in an earlier video, I believe, the ledger shows accounts, and you see on your screen actual accounts, and we'll look at those in more detail. But when a company wants to look at how they're doing in a particular area, they typically will look at the ledger. That will tell them, for example, how much they still owe on a loan for a delivery truck or office equipment, for example. It will show how much we still owe on the mortgage for a building. It will show how much cash we have. So those are items of importance as we go through the accounting period, and the owners may want to check from time to time. So typically they'll look at the ledger. The journal, as we said, is a chronological record of what happened in the business, and we need to use that first of all, and then information from that gets to the ledger. The process of posting to a ledger is really very simple, but it's important that we get the journal right. The journal has to be correct. If it's correct, then it's easy to go into the ledger. If it's incorrect, then you're going to just be compounding mistakes, and that will be evident as we go through these problems. Back to your course page, the first video that I have there for you is a repeat. Back on October 7th, I think was the date, I gave you this as an introduction to the journal and the ledger. And that was the video where I showed you something called key accounts. And that was a skeletal look at a ledger account. And when we look at the full ledger page, if you look at, for example, on your screen, cash here, that's an example of a ledger page. The next one is inventory, another page in the ledger, and this is containing all the detail. But the T account skeletal view is right here. It's still there. You see that something that may look like a T with a debit and a credit indicated there. So that goes back to that video from October the 11th, or 7th, I think it was. At any rate, we need to understand where the money is going to go before we can do the journalizing. So, for example, if we had cash sales, in order to put that into the journal, we had to understand that making a cash sale would mean that we have more cash in the business. Cash would go up, and we know that cash is an asset, and it increases on the debit side. There are some things you simply have to remember about that process. So if you know where it's going to end up, it's easy to journalize, and then taking the information from the journal to the ledger is a relatively easy process. So in my example of a cash sale, we would have in the journal on the date debited cash, for example, because we got more cash, and eventually it would show up right here in the cash account in the ledger on the debit side. So if that happened to be $700, we put that in, and you can see what would have happened to the balance at the bottom. Every one of these ledger pages has a balance indicated at the bottom, which will automatically recalculate if I put some money into the account. If we spent money, for example, if we spent $1,000, that would be credited. That means cash goes down. We have less cash. That is shown on the credit side, which is the decreased side of an asset. So if I put that in, you see what happened to the balance again. It went down. So we start with the journal and then we go to the ledger. So if you get the journal right, you'll get the ledger right in most cases. And we'll be looking at both books in some future problems. But before we get into using both the journal and the ledger, I want you to become familiar with the ledger itself. Again, if you need to go back to that other review video that I have on your course page that originally came from October 7th, do that. You may need to do that at home in the evening when you have some time by yourself to go back and review if you need to, because it's a pretty critical video. You need to understand that concept of increased side and decreased sides of accounts. The T account idea was simply a way of showing a very basic view of what you're looking at here, the general ledger. So that's an important video if you need to review it. Let's look now at the parts of the ledger page. These are assets that you see on this screen. And if you scroll over, you'll see that there are 6 assets and a couple things about them. Not only do we have a debit side and a credit side and this little T account area here that I just mentioned before, you also have a place for the date, and this would have come from the journal. Whatever date we have in the journal would end up in the ledger. This is a carryover balance from last month, actually, and this came from, and this is now going to be using this little column called the reference column, REF. This would have come from J9, which stands for journal, page 9. So this $12,300 would be found back in the journal on page 9. So that's what that little REF column is for. The description is rarely used. Once in a while, something unusual happens and we need to do a little description of what this entails here, but most of the time that column is not used. We also have obviously the name of the account up at the top, and each account has an account number. And going back to our generally accepted accounting principles, GAAP, generally assets begin with a 1. They don't have to, but generally they do. In this business, the first asset account is 101. Down here, the next one is accounts receivable. It's 102, and so on. So each one has an account number that will be used, as we'll see later on. Okay, these are all assets. Down at the bottom, let's look at the tabs. Now I'm going to liabilities. And again, this is similar to what that video back on October 7th showed, only they used, I used T accounts there. These are the actual accounts. Here's accounts payable, and these are liability accounts. These indicate that we owe some money. And all liability accounts typically will begin with a 2. So you see accounts payable 201, mortgage payable 202, and so on. It'll vary from business to business, but basically we will see liability accounts beginning with the number 2. Now the difference between liabilities and assets should be something that you already know based on what we talked about in topic 4. Liability accounts have a credit balance. So here you see again the date, beginning of the month. This came from journal page 9 again. A $500 credit means a $500 balance at the bottom. And this will change as we use this account. So once again, if we would pay money, and let's say we pay $100 toward what we owe. If we did that, there would be something in the journal, and eventually it gets here, and that $100 would be in the debit column because debits show decreases with liabilities. So you see what happened. The balance decreased. If I would charge something more, another $500, for example, then obviously the balance goes up. So you need to know increased sides and decreased sides. And they're all the same. These are all liabilities. There's only 3 of them for this particular example. Down at the bottom, owner's equity. This, as you should know from topic 4, will show the value of the business. It has a credit balance. If we increase it, we put that increase on the credit side and it would increase the balance. If we lose money, it would be shown on the debit side. that would indicate the account is going down. It's losing value. So that's the owner's equity. Then the last two, revenue and expenses. The revenue account is typically sales. We're selling something, but you see no balance there. And there's a reason for that, and I'll explain that later, a little later on. We don't need to worry about it right now, but sales does have a credit balance. If there were money here, if we did make a sale, let's say we made a sale for $600, then it would show a credit balance. Okay. And expenses. Look at expenses. There's a few here, those 4, and they have debit balances. Again, nothing showing here. There's no balance. There's no money in these accounts, and we'll explain why that is later. But if we did pay electric bill, for example, that would go to this account. The account is not called electric bill. It's called electricity expense. So if we paid that and it was $80, that would show a debit balance of $80. Okay? Debits increase expense accounts. Telephone expense works the same way. Debit balance, heat expense, salaries expense. All expenses have debit balances. So this is what the accounts look like in the ledger. In this business, there are just 4 expense accounts. There could be many more. There's just one revenue account. There could be more than one revenue. There may be more than one way that this company makes business. Makes money. So the business may have more than one revenue account. But this has just one called sales, owner's equity. Again, if this is a corporation, that would be entitled stockholders or shareholders equity, the value of the business. Liabilities show what we owe, and there could be many of them here. We have some blank accounts that we could fill in later. And we have asset accounts, things that we own. So this is what the ledger looks like. So at this point, I'll ask you to go back to your course page and answer a couple questions.